Welcome to the REI Diamond Interview, your source for real estate investment jewels of wisdom with Dan Breslin.
Welcome to the REI Diamonds Mid-Month Market Update with Paul Sloate. I'm Dan Breslin, host of the REI Diamonds Show, and today I'm here with expert economist Paul Sloate from Green Drake Advisors, who is going to present us with February's Mid-Month Market Update. Paul is a regular guest here on the show with the Mid-Month Market Update, which is basically a quick overview of the current events and economic conditions as they relate to you, the real estate investors. So welcome back to the show, Paul.
Well, thanks, Dan. It's my pleasure to be back.
So I'm going to turn the floor over to you, and I know you have a presentation of information here to present, so go ahead and take it away.
All right, and for your listeners, should they have any questions, they should feel free to contact my office if they want to have an update on the materials that I'm going to be discussing. And the best way to do that is by calling our offices at 610-687-7766. So our market update this month is going to start off with a focus on what appears to be not related to real estate, but which could have a major impact on your listeners, Dan. And that is, we're going to start off today with a little discussion about the Federal Reserve. The Federal Reserve is responsible for all the money in the country and the creation of money to allow the economy to grow. And what has gone on is that the Federal Reserve has been slowing monetary growth in an environment in which there are a number of economic problems out there. We know that crude oil prices have collapsed, which has led to problems in the energy area here. We know that the dollar is up a lot, which has led to problems with the industrial economy in the United States. So all those things are starting to combine with international developments to make what happens at the Fed key to what's going to happen in the U.S. economy here. We say that because the Fed appears on the brink of potentially making a major policy error that could lead to a recession. So I would advise all the listeners on the phone to watch what the Federal Reserve is doing. Rarely do we say that they should watch this, but the last time we said this was back in 2006, and about 18 months later, we ended up with a recession. So what I would suggest the listeners do is pay a lot of attention to the Fed. Hopefully, they will not raise interest rates, and what they will actually do is accelerate money growth, which will allow the economy to accelerate. If they don't do that, there's a reasonable chance that we'll enter a recession or potentially have zero growth later this year or in early 2017. And that would mean that demand growth for all the various real estate property types that are out there would not happen this year. As a result of not having demand growth for the various property types, it means vacancies would rise across the board for real estate. It would ultimately hurt rents, and it would hurt NOIs on all the properties. So, again, I want to repeat, very rarely do we say pay attention to the Fed, but we're at the tail end of an economic cycle, and it's the point where you need to pay attention. So, assuming the Federal Reserve does the right thing, and in this case, by the right thing, we mean add money to the system, then for many classes of real estate, the future looks okay. It doesn't look scintillating like it did back in 2011, where there were massive opportunities to buy properties at distressed valuations and higher cap rates, but it looks okay. Some areas are growing very strongly, such as data centers. Data center growth last year was almost 15% in terms of demand growth, and demand growth is expected to continue at 14 to 15% over the next few years. This is because data center demand is exploding as the cloud becomes a bigger and bigger portion of overall computing for both the internet and internet service providers, as well as for corporations as they move to source all their computing needs out in the cloud. So that's one area that seems to be doing well and seems to have a very bright future ahead. When we look at certain other areas, such as office is expected to have net absorption this year. In other words, the amount of square footage that is leased is expected to exceed the amount of square footage that is added by office construction. And in fact, office rents are expected to accelerate in 2016 compared to 2015. 2015 office rents rose about 3.4%, and this year they are expected to rise somewhere between 3.8 and 4%, according to REIS, which is one of the major data providers to the real estate industry. So this is an interesting area. Construction in office space remains low, and we think that that is because there's a secular trend out there of lower square footage per office worker, and we think this will continue because people's phone and laptop have become virtual offices. So over time, this trend towards, more open space, fewer real offices is going to continue and probably increase the amount of open space and decrease demand growth for office space over time. However, offsetting that is basically growth in the economy and growth in the number of workers, especially as the millennials enter the workforce. So the future for office looks pretty good from here, barring a recession. So as we look at additions to supply, what we're seeing is a pretty good outlook for a couple of areas. One is data, now two is office. One area that we, however, are not as positive on because of the amount of building that's going on and the amount of building that will continue to go on is the multifamily area. So in 2015, absorptions did not meet added new space. In other words, there were more units added than new units leased. So vacancy actually rose slightly last year and is expected to rise again this year. And what we're already seeing, even before all the new supply comes on, is that vacancy rates are beginning to impact rents, and that will ultimately impact same-store NOI growth. And we do know from what we see from the builders that they're continuing to buy land to permit it to add supply. So we expect supply to continue in 2016, 17, and probably 18. And in all those years, it looks like supply is going to exceed demand. For sure in 2016 and 17, because that space is already under construction, and much of what will come in 2018 should be under construction by the end of this year, barring a U.S. recession. So if we were to look at the supply growth for a multifamily, it is the one area that we would consider that people would need to watch out carefully. In other areas, such as self-storage, supply growth is up, but supply growth is merely back to the levels that were happening, shall we say, in the late 90s. So if we look at the amount of money that's being spent, yes, the amount of self-storage space is growing. However, it is not growing at an excessive rate. And in fact, absorption is expected to exceed the new square footage added this year and next year. So for right now, self-storage looks like an okay area, and self-storage also may benefit from a number of potential corporate roll-ups that we know have been formed or are being formed, where investor groups are looking to go out and buy self-storage assets and ultimately roll them up into larger companies that they can then take public as REITs. Because the self-storage area is highly fragmented compared to many other areas. As a result, we would expect these groups to try to roll up this area just as they are rolling up other areas of the economy that are highly fragmented in the economy. In terms of a couple of other observations on things that we see going on, we have to take a careful look at the cap rates on properties that investors have been getting. Cap rates have been relatively low because interest rates have been low. However, there are a couple of things going on. One, interest rate spreads have gone out significantly from where they were. They're out several hundred basis points from a little over a year ago. And those spreads will ultimately impact how real estate is financed and the valuations for various property types. While overall interest rates appear to have stayed low, interest rates for BAA, which is typical corporate debt, or for even low-quality junk, has gone out significantly because of all the turmoil in the energy patch and overseas. And as a result, investors have to think about whether they're going to be able to sell their buildings at the same types of multiples of cash flow that they have over the last few years. We would guess that that multiple will come down over time, is unlikely to go up from here, and we expect that over the next 5 years, you're going to get ultimately higher inflation and higher interest rates, which will also impact the multiples on the building, i.e., they will bring the multiples down and back towards what we had back in the early 2000s and late 1990s. So for investors in real estate, that could end up as being a shock because many of the builders are used to building, shall we say, an apartment building and then taking 100% of their capital out when they refinance it at the point where the property is leased up. We know from seeing a number of private placements that that is sort of the developer's mantra today, is build the building, then recap it at very low cap rates so we can take all our capital out, pay out our investors, and pay ourselves a promote. And so that model is, while being used today, in about 3 to 4 years is unlikely to be sustainable because of the rise in interest rates over that time frame. So there are a couple of other things that we would mention to our listeners today that they should keep in mind about real estate. From our perspective, what we're seeing in the housing market, which I know a large part of your listenership is focused on, is that units are still well below replacement levels. So what that means is that housing should stay relatively tight even in a recession, and that home prices really shouldn't come down much, if at all, should we have a recession. And we're quite positive on housing over the long term because the millennials, which have moved into their prime rental years now, will be moving into their prime home buying years in just a few years, starting around 2017. And in fact, we've already seen an impact in that all those who are in the houses, who should never have been put in houses in the 04 to 07 time frame, are now back in rental housing, and the percent of the population that actually owns housing bottomed early in 2015 and has been rising since then. It bottomed around 63.2% and ended 2015 at 63.8%. So it started to creep up, and we would expect this to continue as the millennials move into that demographic time frame of buying houses. So for those of you involved in finding houses, renovating them, and reselling them, you probably have a pretty bright future as the millennials move into their prime home buying years, especially with starter homes. There's one other thing I would comment on, which is the rate of economic growth. There has been, over this recovery, a very low rate of economic growth compared to history. So on average, the U.S. economy has grown about 2% this recovery. in a normal recovery, the U.S. economy grows 3.5% to 4%. So we've grown at about half the normal rate. We think that this is becoming a political issue and that it is likely that there will be a focus on the rate of growth in the economy under whomever becomes the next president, whether it's Donald Trump or Hillary Clinton or another candidate. As a result, we expect faster economic growth, which should, on the whole, enable faster demand for real estate space. So the two happen to be linked at the hip. So if we get faster economic growth, we should see more demand for space, and we should see more opportunities to build houses, to build buildings, build industrial space, etc. And I think that this will be a focus and something to keep your eye out on because it could be a big benefit to the whole real estate space. That's all I have for this month's mid-market update. Dan, do you have any follow-up questions?
Well, I think that's great. And other than the eye on the Fed as an indicator, are there any other short-term news items or things that we should keep an eye out on, say, in the next 2 or 3 weeks that could have catastrophic effects, if anything at all, Paul?
Well, it's unclear. There's a lot of pressure internationally. And when I think internationally, I'm thinking of countries like Russia. I'm thinking of countries like China. I'm thinking of countries like Nigeria or Brazil. All those countries have serious economic problems. And should those problems not remain contained within those countries, then you could have spillover effects into the U.S. market and the U.S. economy. So if you're going to watch anything besides the Federal Reserve, I'd pay attention to some of these international developments because they could have serious negative consequences for the economy.
All right, I've noted that. And I'd like to just wrap up by having you share one more time your contact information, Paul, if anybody'd like to get a hold of you or has any questions.
So if anybody would like to get a hold of me or ask me questions or discuss any of these topics in more depth, I can be reached at our offices at 610-687-7766. And my assistants will set up an appointment and we can spend some time together on the phone or in person. Thank you very much, Dan.
All right. Thanks again for coming on, Paul. Appreciate your insights here. And to you, my loyal listeners, I thank you for tuning in to the mid-month market update of the REI Diamond Show. We will be back again around this time, March, and we will have some additional updates. Paul will be back on the show. And if you know anybody else who might also appreciate this episode, please forward the link. And you can sign up to receive a new episode notification each week at www.reidiamonds.com. Thanks again for listening. Dan Breslin here. I'll catch you next time. And remember, here at the REI Diamond Show, we're dedicated to increasing, multiplying, and protecting your net worth.
Thanks for listening to the REI Diamond Interview. To receive the REI Diamonds newsletter and interview monthly, sign up now at www.reidiamonds.com.